Hi everyone, hope you're all doing well, and today I'm going to talk about the three stocks I'm buying at the moment. So these three companies I actually bought last week, and we're going to do a video that I've not done for a little bit of a while, but I'm actually going to go quite deep into the companies and talk about why I'm buying them, what's kind of going on with these companies. As always, when I'm kind of looking to buy companies, then normally the companies I'm buying are the companies that are going down rather than up, because normally if I see a company and I start buying it and that share price is going down and down, I'm just thinking, well, I'm getting a great company for cheaper and cheaper prices, and in the long run, what's that going to mean? I'm going to make more money in the long run because I'm getting the shares at cheaper prices. So that's generally something that I want to kind of consider and put out there, because every so often I feel like we just kind of have to refresh what the mentality is and what I'm kind of looking to do in the stock market and how I achieve the most money in the stock market, I guess, because it's very similar to like if we went back to the stock market at maybe the start of 2020 when we had the whole CV situation. When you look at the CV situation, how did you make so much money? Because you were buying stocks that were selling off. And that's what you, as an individual stock picker, what you try and do is you kind of look at some share prices and you look at the share price action and you go, okay, that share price has lost 20%, 30%, 40%, 50%. These share prices are losing a lot of, a big massive percentage. The company's losing, half its valuation right now. And is that a reflection on what the company is doing? Because that's what you got to kind of look at. You got to look at a lot of these companies that are out there, and you've got to look at these companies and then look at the share price and go, is that share price just reflecting what's going on in the company right now? And quite often that's how you can find some really good bargains in the stock market, and how you can kind of beat the stock market in general is by finding some of these really good opportunities on stocks, buying them at cheap prices, buying great companies at cheap prices, and then when people kind of realize, oh, you know what, that was a bit of an overreaction, that share price selling off that much, that's where you go make some good money and outperform the market. And these three companies are prime examples of that. These are three companies that I believe are very good companies, but when you look at the share price isn't really reflecting what's going on in the company. For example, these three companies, I think all of them in fact are massively increase in profit, massively increase in revenue, but all three of these companies have had massive slumps in the share price, and that's where you see me come in and buy them. And I just thought like that mentality point of view is something just to kind of just refresh, especially with two of them, because I feel like there's definitely a lot of negativity out there with two of these companies for sure, but all three of them are kind of beating down stocks, and that's where I come in and buy them. And I'm not kind of thinking, in the first kind of month, 2 month, 3 month. For me, as a long-term investor, I'm thinking about these companies in the long term, not kind of thinking about, okay, can I make a little bit of a return in, a month's time, 2 months' time. I'm not expecting anything to happen overnight. But when I look at these companies in the long term, I feel like the great companies massively sold off, and this is why I'm buying all of them. And like I said, today is going back to the videos where I do a lot of deep dive into them, do a lot of talking. It's going to be probably a longer video. I don't know how long it's going to be right now, but by the time you guys see this, you'll be able to see how long it is. This is where I put a lot of time in, a lot of research in. It does take a while to put these videos together, so if you could smash the like button, if you're new, subscribe if you do find it helpful. And if you do want to know when I'm buying or selling companies like these three, join the Patreon. I posted last week exactly when I bought and sold bought these companies. There were no selling of the companies, just bought these companies. And as well as the buy and sell alerts, there's a Discord with 650 members on there. There's also on the Patreon 2 exclusive videos a week, and they can be different videos, from education videos to portfolio reviews. There's a lot on there, so if you do want to join that, links in the description. And if you do want to start buying some shares, there's some links to some brokers in the description as well, like free trade, like stake. You join through there, you also get a free share as well. But we'll get stuck onto the three stocks that I'm buying, or the three companies that I did buy last week. And as it probably looks right now, there's a few of these companies that I might buy going into this week as well. So number one is the only US stock on this list. The other two are going to be Chinese companies, so I'll give you a little bit of tip. You might be able to guess which ones they are. With me saying that, but yeah, Corsair was the only US company that I bought last week. But yeah, I'm a big fan of this one, and I'll go through the reasons why. So Corsair is currently trading at $29. The ticker symbol is CRSR. If we just go onto the 1 year chart here, we can see that it came onto the stock market around September time, which was a fairly good IPO. It had a very good run up, and then since about February time, it's come down to from about $45, and then it's gone down to about $31. And ever since kind of this March time is where I've started buying this company, but it's kind of just really been flat since its IPO, and this is where I've started buying this company when I can. So one of my favorite things to do in the stock market is to kind of look at some of these IPOs that come into the stock market. you let the hype build up, and then eventually they sometimes have these little slumps where they go down. So you can see here we are 34% off all-time highs, and I like picking up these sort of companies because you get the hype and then they kind of calm down, they don't do anything for a little bit, and then eventually investors start to come back into them, and you also get some insiders that might want to sell out the company as well. And that's what's kind of going on with here. And I'm looking at this sort of thing, it's very similar to like my positions in Dropbox, did something very similar with Dropbox. Pinterest is another one, and Revolve, some of you guys might remember that one from last year. That was a very good stock for us, and yeah, this is the company that kind of reminds me a lot about them guys, especially Revolve at the moment, especially when we look at the metrics. But basically these guys do hardware components, but they're a lot more than that, and we'll talk about that in a second. But just from a valuation point of view, it's so cheap. You know, we look right now, we're just going to pop onto Yahoo Finance here, and you can see here we're currently trading at a forward P of 14, which is really good for a growth company, and with a trailing P of 18. So yeah, you look at the current market and all that, and you think, okay, we've got a company that's going to be in a growing sector. It's going to be growing decent profit, decent revenue, and it's just really cheap. You know, price sales ratio, we're down at 1.4 price sales ratio, and yeah, everything you're looking at metrics, to buying up a growth company like this at a 14 forward P ratio is so good in my opinion. So mainly Corsair are kind of known for their PC components, so they do all these parts here, but as well as that, obviously PC components, people are thinking that was the big boom that we had last year. So these people are starting to think these guys are a one-trick pony, but they're a lot more than that. They own a lot of brands, and they do a lot of you got a lot of streaming gear here as well, and streaming is very popular. You know, they've got the Elgato brand, they've got a Gamer Sensei brand, they've got loads of different little brands here, and people are kind of thinking this is only benefited from the CV situation, but it hasn't. You know, we look at what's going on right now, and this was a latest numbers that came out, and video game sales in Q2 pull off surprising 2% gain against tough pandemic comparison. So even against really high numbers, and sure there's been a little bit of growth pulled in, but people are still going to be playing video games for a very long time. It's mainstream, it's popular, and even like a lot of teenagers that are growing up nowadays, what do they want to be? You know, a lot of them want to be you know, streamers, and what they want to have is a lot of the streaming gear that they have right here. And also, what does everyone want to have? They want to have a nice computer. You know, quite only, you know, if we pop back last decade, the trend was to go for laptops, and you know, how small can you get your laptops to be, and everything like that. But now we're switching back to actually like tower computers, and people want, you know, nice, you know, the fastest computers they can have. They want to have really nice lighting, and Corsair are really going to benefit from that. And like I say, it's not just from the point of view of that, you know, the Elgato brands as well, Gaming Sensei as well. You know, chairs, mice, accessories, lighting, apparel, and these guys have a really good reputation. You know, these are kind of the high-end part of the gaming, and they've got great reviews as well. And just to kind of put that into context as well, you know, if we go back to back into like let's say March 31st 2018, you know, this company was doing 923 million. If we just go back to just before the CV, so you can't even say this was the CV, 1.1 billion, and the profit's growing. And you know, this company, sure, there's been some demand brought forward, but it's still going to grow at a nice little rate. You know, maybe 10% here. They're going to make a nice bit of profit right now, and yeah, it's a really great company. Looking at the balance sheet was probably one of the only things that was kind of the weakness in my opinion about this company. But you look at this, okay, the debt to equity went a little high. You know, they've been buying out a lot of brands at the moment, which is going to work for them because that's going to bring in the growth in the long term. But now they're making a lot of profit. What they decided to do, look at that, they're paying the debt down as well. So even though the balance sheet was probably the weakest part of this company, what do you have right now? You have debt being paid down because they're making profit. And you look at that debt to equity, look at that 205%, and then we've flicked to 60%, which is really good. And then you look here, you look at the debt here, they've got a little bit of cash sitting here. So yeah, this is all great from this point of view. And just going to the point of the management team, this is what I mean about the IPO. If we look down here, Eagle Tree Capital was the biggest shareholder in the company that are kind of reducing their shareholding quite a bit. And these are the guys that wanted to take this company public. They wanted to take the company public because they wanted to sell the company. And then they decided, you know what, let's take it public, and then we can still own a bit and still sell some of our position. And you can see here, they keep selling a big fair chunks in their position, which is going to happen. And this is the whole reason why it's going to go public. But what's going to happen in the next, 2-5 years? They're not going to sell as much, and then it'll kind of level out and the buyers will come in. This is what's kind of holding the share price down at the moment, but in the long term, in my opinion, EagleTree will stop selling a lot of shares in the forward, but that's going to happen in the short term. This is why we're having the dip in the share price. And the big thing here is when you look at the management team that we have in this company, we currently still have the founder, Andrew Paul, here, who I believe has been in the company for 27 years, who has a decent ownership in the company as well, still owning massive amounts of shares in the company. So this is really good from a management point of view, is that we've seen a founder-led company here that has 27 years experience in here with a decent bit of holding in the company as well, which is really good. So from my point of view, I think that Corsair is a really good company, massively sold off now after its IPO. And yeah, from my point of opinion, I'm looking at this as a 2 to 5 year hold, and I'm kind of thinking, you know what, I can see myself getting somewhere between $60 to $90 in the 2 to 5 year period. So yeah, for me, a nice easy 100 to 150% return on this one in the next 2 to 5 years, and that's why I'm buying this company. And I think once people get over this point of view that they think, oh, this kind of bump in Corsair revenue and profit was because of the CV, you know, it's obviously it's not going to grow as quick as that, and there's been a little bit of demand pull forward, but in the long term, people are still going to be gaming, people are still going to be wanting to buy a lot of these component parts as well, a lot of this streaming gear, the Elgato brand, a lot of this Gamer Sensei brand, and yeah, I think it's here to stay for the long term as gaming and streaming is coming more and more mainstream, and yeah, I think it has a very good future, so that's why I'm picking up some more shares in Corsair. Number 2 is the first Chinese company on this list, which is Alibaba, and this one is the giant of China. And basically, yeah, I've been buying a few more shares in this one. I've been holding off for a little bit, and now it just keeps going down. I'm buying a lot more, and yeah, I see a good return on this one. I made some good money previously on Alibaba, and I feel like I can make some more money again on Alibaba. Obviously, at the moment, this and the next Chinese stock have been hurt a lot by a lot of the Chinese tension that's out there right now. There's a lot of negativity in China, and as we're recording this video, even in pre-market, a lot of the Chinese stocks have taken massive battering, we'll put it that way, and they've been hurt. And at the moment, this reminds me a lot of 2018. There was a lot of negativity to China. There was a lot of China trade war that was going on. There was a lot of stuff with North Korea at the time, and the thing is as well is like the media love pushing this sort of stuff because the US media for me is the biggest threat to China. They are massively anti-Chinese, and back in 2018 there was all this talk about delisting. But yeah, there was a massive amount of negativity towards Chinese stocks, and you know, we're 3 years on now, what ended up happening from there? Absolutely nothing. And same again, at the moment, you know, the media sell stuff and people watch. It's like CNBC. People will watch the media or watch TV programs or buy newspapers or read articles on negative stuff. You know, no one's bothered about positive stuff. No one's bothered about when things are going well. People want to see negative stuff. The media want people to watch their stuff, and the way to get that is by posting fear out there, negative stuff, or this is happening, this is going wrong, and that's what people want. You know, that's the thing. You know, the US media never talked about China over the last 2 years when share prices have been doing very well, because no one wants that. No one wants to talk about anything that positive like that, and that's the thing you always got to remember. And like I say, 2018 was the last time I saw there was share prices of like JD.com, Alibaba that I was buying, and I made a good 80% on Alibaba from the 2018 kind of Chinese tensions, and JD.com was up like 300-400% after buying after them. Stocks absolutely fell off a cliff, and it kind of reminds me of what's kind of going on right now. And the thing is, you got to just kind of remember, what is the company you are buying, and do you think the company is going to be okay in the long term? And once again, this is a Chinese company that I'm looking at Alibaba thinking, same again, I can make a good 50 to 100% return on this one, and yeah, that's why I'm buying Alibaba stock in general. So if you don't know Alibaba, they own many brands. Obviously the Alibaba Group, which a lot of people compare to Amazon. It's not like Amazon actually, it's more like eBay, because they actually don't have the products themselves compared to like Amazon. But in general, like the amount of things that's involved in is obviously a lot. You know, Alibaba, AliExpress, the cloud side of it, Tabeyo, which is a bit more compared to Amazon actually, Tmall, Ant Group, yeah, they've got basically, you know, they cover so many sectors. Basically, if you are in China, then you are going to use one of Alibaba products, and the more they expand, they've put so many, they're developing so much, loads of little mini investments, and yeah, they basically cover so much and so many industries that you have to basically use a lot of Alibaba products in China, which is great when you've got one of the fastest growing economies out there, and also then they're expanding international, which is really good. So from a company's point of view, is like, you know, it's a massive moat. Alibaba's going to be around in China for a long time because they're covered in so many different sectors. Now, just on the share price point of view, you can see here that it's down in pre-market, as you can see. But yeah, since about October time, yeah, the stock's down 32%. And if I can just back to this, so when I was just talking about 2018 a little bit earlier on, you can see this is what happened in 2018 when the same sort of fear was out there for Chinese stocks. And you can see here the company went down 36%. We pop back to where we are now, we're down 33%. And see what I mean? It's very similar to what happened in 2018. And look what happened after 2018. Boom. There you go, that's where I made a lot of money in Alibaba stock last time. And I'm thinking exactly the same again. If I just pop onto the valuation point of view, you can see we're trailing P of 24, which is going to be, when we look at the growth, you know, this, when you put into the context of like the growth that Amazon has and the valuation they trade at, which is absolutely insane. Obviously, that you won't ever have Alibaba trade at the same valuation of Amazon just because it's a Chinese stock. I know it's wrong, but hey, we've also got to take that into consideration, and also because of it being in the ADRs as well, which if you don't know, have a quick Google just so you know what you're owning. And then a forward P ratio of 17. As you can tell, when I see companies at a forward P around these sort of teen ranges, I do love it massively. And look at that price sales ratio. Oof, absolutely crazy. This is what I mean when we talk about how good this company is growing. So look at this revenue growth here. You know, this company is growing like 30% revenue growth rate. It's got a lot of profit down here. And this is what you're picking up, you know, 17 forward P ratio coming in on here. And look at the growth, and it's just going to continue growing. And sure, there'll be a lot of fear out there whenever they want to put them fear out for Chinese stocks. But in the long term, this company is absolutely solid. Financial, health-wise, it's very strong. You see the debt's pretty much stayed around the same as the equity kind of raises. And yeah, the cash to debt is very, very strong on this company. And in the long term, as you can see, I think this is basically 2018 repeating itself on Alibaba. So when I look at this company and think, what am I getting for the share price at this valuation, the growth I'm getting, you know, that 30% plus revenue growth at this sort of valuation, it's just screaming 2018 all over to me again. And once again, yeah, I'm looking somewhere probably around, I would say 50 to 100% return. I probably would be looking more to the 100% return on Alibaba. And yeah, it's a great company. It's the one that you probably want to own in China, I guess. And even if there's a little bit of crackdown on how much they can carry on growing because of a monopoly, they're still going to put in fantastic growth numbers. And yeah, that's definitely another stock that I'm looking to buy at the moment. And number 3 is Huya. So the second Chinese stock on this list, and once again, this stock has been absolutely tanking over the last kind of few months really, maybe even half a year. A lot of negativity with this company, and the valuation at the moment just seems absolutely crazy. And yeah, a lot of this is once again very similar to the Alibaba stuff. At first I thought it was kind of like the merger that was kind of holding this company down, and I thought, you know what, the terms of the merger was unfavorable. Once this has kind of gone through or it stopped, then the share price will move in the right way, but it hasn't. It's carried on moving down, obviously probably due to a lot of the negativity that's out there in Chinese stocks, which you're seeing pull every single Chinese stock down right now, and it just gets beaten and beaten down. And yeah, this company is just really crazy valuations right now. And the big thing as well is like this sort of company is that this is for sure the worst performing stock in my portfolio at the moment. And it is funny because this stock kind of overall kind of sums up the mindset of the stock market right now. You know, if you look at a lot of companies at the moment, let's say that I've talked about, like, let's say S4 Capital, let's say Facebook, let's say Microsoft, Greg's, National Express, you know, no one really talks, no one's really interested about these sort of companies because they're going up and up and up in share price. No one really cares when the stocks are going up in share price. Everyone's like, oh yeah, happy days. But as soon as you get one company that kind of goes down, it's really funny to see how tension that this company can get because it's going in the wrong direction sums up the stock market in general. Because when stocks go up, everyone's like fine and happy, but when stocks go down is when you see panic, and that's why also you see the share prices go down a lot quicker and a lot faster. And this is why when people kind of see you know, stocks go up, they're happy and everything like that. And why stocks go down so quick is because of this situation like Huya. You know, you look at Huya and everyone's kind of talking about it, everyone's like worried about it, and this is, you know, people panic and people panic sell as well, rather than not understanding what they're owning and kind of thinking, oh, you know, this could be a really good opportunity in the long term. And yeah, this is a prime example of like the mindset of how fear can move stocks down a lot faster than when stocks go up, and how people kind of view things, and how people can actually lose money in the stock market, for example. Now, with a lot of that said, I am going to say that the thing with Huya is that I have to be very careful with this company now, because I don't want this company to make up a huge amount. Even though the company's kind of getting to better and better valuations, it is like catching a falling knife, and I want to be careful that I don't commit too much of my portfolio into this one stock when it is a stock that isn't going to be a biggest position. So even though the stock's going down, I have to be very careful when I do buy in. Not every, even though it's like going down every single day at the moment, I have to be careful not to buy every single day and just kind of slowly keep averaging down, because the thing is, no one knows where the bottom is. If you knew where the bottom was in this company, then you would just wait for the bottom and you'd buy there and you look a genius and it would go up. And that's why if everyone knew where the bottom and the top of the stock market was, everyone would just buy at the bottom, everyone would sell at the top, but you don't. It's the stock market. People don't know where the bottom is, people don't know where the top is. But at the moment, it does seem like a good value, but at the same time, just got to be careful. I don't know where the bottom is. I thought the bottom would have been a long time ago, but it seems like it's just going lower and lower. And that's the one thing that I do have to be careful with Huya right now, and I've got to make sure I don't commit too much money into it. Let's say use all my cash pile up, and then I've got no more money if it keeps going down, $10, $9, $8. So that's something I do need to be very careful of with this company. But saying that, it is looking at incredible value. And we'll just take a look at Huya right now. So if you look at Huya right now, it's currently $13. Pre-market is down 5%. Now, if we do look at this stock right now, you can see it came onto the stock market in 11th of May 2018 at $16, and then it shot up to $46, and since then it's been on a downtrend and it's pretty much done nothing. And in fact now, obviously we're down at $13, potentially when this goes up it will be down at $12. And yeah, to think that we are now 3 years on since its IPO and the stock is lower valued than where it was 3 years ago. Now in that time, this company has grown profit a huge amount, revenue has grown a huge amount, and it is, lower value than where it is right now. And the thing is as well, is if you look at the $13, this is kind of now valued at the same time peak CV levels. This is kind of valued when we've generally thought, okay, there's a pandemic here, how bad is this going to be, how many problems will this cause, and all that uncertainty. And this company is now further down there, and in the last year it's grown revenue, I think 30%, profits grown a really good amount, and yeah, it's lower value than that. And that just kind of sums up how cheap of an opportunity this is right now. Now, if you don't know what Huya is, basically it is the Chinese streaming platform here. So obviously there's a lot of streamers, mostly focused on games. Obviously games are going to carry on growing, esports as well, and obviously esports are going to keep on growing. And they also keep signing a lot of really exclusive content with Tencent, and that partnership seems getting a lot more stronger. So I feel like potentially what would make sense is if Tencent right now would go out and buy the company in full. That could be something that we see, because obviously they tried to merge Douyu and Huya, but obviously that's kind of not gone anywhere. So it seems like out of every company, out of Douyu and Huya, it seems like their partnership with Huya would be slightly stronger because of the licensing deals they do. But yeah, massive growing sector here. Esports has grown huge. It's filling in massive amounts of venues, and yeah, to hold the number one streaming platform in China, with one of the biggest growths here, with one of the biggest growing areas as well. It's a great company. And we just look at the financials here. The trailing P here is a 23 P ratio. The forward P is 14, so this is even cheaper on a forward P basis than Alibaba, for example. Price sales ratio is down at 0.28. Now, if we just compare that, for example, to something like a Twitch, which is basically the American version of Huya. This company was actually bought out in 2014 by Amazon, and this was 970 million. Now back then, Twitch was only doing a small amount of revenue, and I believe that Twitch actually was bought out by Amazon for around about 90 times sales. Yeah, 90 times sales. And you look at what Huya is currently trading at, and Huya is trading at a 0.28, which is crazy, isn't it? And then another very similar company, which is a Chinese company, so I'm not going to compare this to like an American company, is Bilibili, and this is basically the YouTube version of China. And these guys have done very well on the share price recently. And you look at Bilibili, their current price sales ratio, currently trading at a price sales ratio of 15. Now I know there's a lot more growth here, but it is unprofitable. But you look at Huya, And it just looks so cheap compared to even another company that's very similar to them. And it just seems massively beaten down. And once again, when I talk about it being a good company, I'm not making that up. If we just look at the company here, look at this revenue growth. Look at 2018. You know, this is when it came onto the stock market, 2.6 billion, and we look to where we're at now, 11 billion. You're reading this completely right. I'm not making this up. This is they've grown their revenue 5 times since their IPO, and it is valued at the same price as the IPO. Yeah. And you look at this company here, that, you know, they're losing 555 million, and just to make, this isn't in dollars, by the way, just to make that clear. There's always one person that goes, but it's not in dollars. I thought people would be able to read that, but I'll just shout that out. And look there, now profitable. You know, losing 500 million to just short of 900 million. And that's a change in a few years. It's just really good performance, isn't it? Financial health-wise, you know, this company is growing a huge amount, and also the balance sheet is just getting stronger and stronger. We look at the cash to debt. You know, there's no debt. Sorry. Look at the cash, which is also at 10 billion, which is really strong. And if I actually just do, I'm roughly going to convert that in my head. But I believe if I convert that roughly in my head, that would be actually around about $1 billion in dollars. Now, if we actually just go back to the stock price, it's actually 3 billion. You know what? I'm actually going to get a converter out here just to kind of just check. So actually, it is 1.54 billion. So we just go into the market cap here. The company is currently worth 3 billion, and half of their market cap is currently held in cash on their balance sheet. So put it this way, if you bought out Huya for 3 billion, you would then instantly get half of your purchase back in cash, which is nuts. So you're basically paying nearly 1.5 billion for Huya at the moment. And it's just absolutely crazy valuations. If we just go on to the management team, decent ownership, been there for quite a few years as well, which is really good. Let's just have a quick flick through this insider holding here. So you can see here, this is Tencent that obviously hold the majority, and I won't be surprised now if Tencent just go, you know what, we like Huya, if we can only get one, let's get Huya, and buying this out because they've got such a good holding. Obviously they've got Joy, and look at this insider holding here, you know, 20% increase. Bailey & Guildford here, 30% increase. Morgan Stanley, 37%. Another one here, 98%. Obviously, ARK have been selling out a lot. They were once one of their biggest shareholders, and they've been selling out a ton. You know, screw Cafe Wood and all that. But Fidelity down 12%, BlackRock up 26%. And yeah, it just seems like there's a lot of insiders buying up. Obviously, there's some selling as well, I will say that. But yeah, it does seem quite positive, the amount of people that are buying up this company right now. So even though Huya is getting absolutely sunk, and I will not rush in to buy it completely, I'll just keep buying here, there, while it kind of, because I don't know where this is going down. There's no way that I thought it would be at this sort of valuation. Like I said, you're talking where it was at, you know, the pandemic levels. You're talking about when it was like an IPO, and what I just showed you there, you look at the revenue and the profit, and yeah, there's just no way I kind of thought it would be at these sort of levels. So I don't know where it's going to go. I don't know how low it's going to go, but I'll just kind of keep buying here and there, just keep my position going, because like I showed you from there, you look at the company's performing so well financially, and it's just like the share price isn't reflecting it. And yeah, that's what happens sometimes in stocks, and that's all I'm kind of buying. You know, I'm looking at this thinking, is it a good company? Yes. Is it at cheap prices? Yes. So when I'm kind of buying this one for a 2 to 5 year hold, I think it'll be higher than where it is right now, and I feel like it should be, especially when we compare the valuations to like Twitch and a Bilibili. Fair enough, that's an American company, and the other one has a little bit more growth than what Huya has. Should it be trading where it is right now? In my opinion, it shouldn't be. You know, I've always said, for my opinion, Huya is, in my opinion, is a $40 stock plus, and it's been disrespected for a while. And yeah, I'm happy to continue holding it, because when I look at fundamentally how is the company doing, it's performing, but the share price isn't reflecting it. And that doesn't bother me, because I feel like one day people will wake up and they will buy this company. And yeah, I will continue to buy this one, and probably, maybe, I don't know, by the time you actually see this, I might have bought some more. We'll see. You guys on the Patreon will know that if I have done. But yeah, hopefully that was useful. And like I said, it's a bit of a longer video today. It's one where I go a little bit more detail into the companies. But sometimes I know you guys, some of you guys really do enjoy when I do go down into the companies a little bit more detail than just kind of talking them about a minute or two. So hopefully it was useful. And if it was, and you made it to the end, smash the like button, subscribe, and I'll see you next one.